Usually when you look at a 173-year-old legacy company, you expect this slow, creaky, totally resistant to change behemoth.
Right, like a massive cargo ship.
Yeah,
Yeah.
exactly. It's like watching a cargo ship that takes like 10 miles of open ocean just to turn a few degrees. You
Yeah.
just assume they're coasting on brand recognition and historical
It's
momentum.
a pretty common assumption, yeah.
But then you look under the hood of what they're actually doing on a day-to-day basis, and suddenly you realize that cargo ship is uh, actively throwing huge pieces of itself overboard just to win a speedboat race.
I mean, the visual of a 173-year-old cargo ship trying to keep up with a speedboat, it perfectly captures the reality of modern corporate survival.
It really does.
We tend to assume legacy means static. Right. But true legacy is often built on this ruthless, almost painful adaptability. Because if you don't adapt, well, you just become a museum exhibit.
And that adaptability is exactly what we're looking at today. Welcome to this deep dive, where our mission is to decode how an iconic American clothing giant navigates the chaotic, completely unpredictable modern economy.
It's a wild ride.
It is. Now, the source material for you today, it might seem a little dry at first glance. It's an SEC Form 10Q, an AGR filing from Levi Strauss Company for the quarter ended May 31st, 2026.
Hot off the presses.
Literally, it was just filed today, July 8, 2026. But I promise you, this is not just a spreadsheet of numbers. It is a dramatic story. We're talking about shedding iconic brands, a massive shift in how we actually shop for clothes, and like getting caught right in the middle of a multi-million-dollar Supreme Court battle over global trade.
Yeah, when you strip away the dense regulatory formatting, a quarterly financial report is essentially an X-ray of a company's strategic health.
Right.
It shows you the fractures, the growth plates, the structural realignments that you just can't see by looking at marketing campaigns or, the storefronts at your local mall.
Which is why we dig into them.
Exactly. And the foundational principle we need to establish right away for this particular X-ray is that we are going to be looking primarily at what the filing calls continuing operations, which, for Levi Strauss Co., means the core Levi's brands operating across the Americas, Europe, Asia, alongside a newer brand they manage called Beyond Yoga.
Yeah, Beyond Yoga's in there too.
And the reason we have to explicitly carve out that term continuing operations is because a massive piece of the company you might be familiar with is just, well, it's now entirely gone.
Completely removed from the equation.
Okay, let's unpack this, because the very first structural change detailed right at the top of this document is a blockbuster. They sold Dockers,
Yep.
the entire Dockers brand, out of the portfolio, gone.
It's a massive divestiture, honestly.
Yeah.
And it speaks volumes about their current corporate philosophy. And, this wasn't a sudden panic sale either. The filing lays out a very deliberate timeline.
Right, because back in late 2024, Levi's initiated this formal review of the brand, and then by July 31st, 2025, they sold off the U.S. and Canada operations.
For a pretty substantial amount.
Yeah, for $194.7 million, netting a $139 million gain. But they didn't stop there. They just finished selling off the remaining international operations of Dockers in multiple closings, with the final one happening on February 27, 2026.
Which brought in another chunk of change.
Exactly. Another $96.3 million, giving them a $17.3 million gain. So they are completely out of the khaki business. To me, it's like cleaning out your closet to focus entirely on your core wardrobe, right? You get rid of the stuff that's taking up space so you can invest in the pieces you actually wear.
That's a great way to look at it.
But I have to push back on this strategy a little bit. I mean, why would a massive apparel company sell off a globally recognized brand that people actually know and buy?
It seems counterintuitive.
Right. Isn't bigger always better in retail? Don't you want to dominate as much shelf space in the department store as humanly possible to block out your competitors?
Well, what's fascinating here is how the accounting terminology reveals the underlying business philosophy. In the filing, Dockers is classified as discontinued operations. So by entirely separating it from their core financial results, Levi's is signaling to the market that managing this sprawling portfolio of different brands is no longer their path to growth. Size for the sake of size can actually become a really heavy liability in today's market.
But I would think having more brands gives you a safety net, Like, if jeans are out of fashion one year, you fall back on khakis.
Sure, in theory. But consider the internal resources required to maintain a global brand like Dockers. It's not just about physical shelf space.
What else is into it?
You need separate marketing teams, completely different supply chain logistics, specialized design departments, distinct social media managers, and crucially, executive attention.
Oh, right. The executives have to oversee all of it.
Exactly. Every hour the C-suite spends figuring out how to revive khaki sales is an hour they aren't spending optimizing Levi's. In a highly volatile retail environment, that kind of distraction is incredibly costly.
That makes sense.
By shedding Dockers, Levi Strauss is executing a strategic retreat. They're liquidating an asset that required too much maintenance relative to its growth potential. And they take that capital, hundreds of millions of dollars, as you noted, and refocus it entirely on their core strengths.
So it's a very deliberate choice to be exceptional at one thing rather than trying to be pretty good at many things.
Exactly.
It's an aggressive move, but when you look at the current financial performance of this new, slimmed-down Levi Strauss Co., the strategy is clearly paying off. I mean, the Q2 2026 numbers for their continuing operations are honestly fantastic.
The intense focus on the core brand is certainly yielding results. The data paints a picture of a company that has confidently found its footing post-divestiture.
Net revenues for the quarter hit $1.56 billion. That is an 8% increase from the same quarter in 2025. Now, the filing also says that's a 5.7% increase if we look at it organically.
Right, organic growth.
I see this term thrown around a lot in financial news. Organic growth basically means growth from your actual core business, stripping out smoke and mirrors like, I don't know, buying another company to boost your revenue artificially, or favorable foreign currency exchange rates, right?
Yeah, is a perfect summary.
Huh.
Organic growth tells you if people are actually buying more pants or if the math just looks better on paper because the euro is stronger against the dollar this quarter.
Got it.
So a 5.7% organic increase in a tough retail environment, that's a very solid indicator of real fundamental consumer demand.
And their net income jumped to $87.3 million. So they're a leaner organization, but they are making more money.
The efficiency is showing up in the bottom line.
Yeah. And the filing breaks down exactly what constitutes that $1.56 billion. 67% of the units sold are pants. So that's jeans, casual pants, skirts. Tops make up 29%. Demographically, men's products account for 58% of revenue, while women's make up 41%.
Those product and demographic mixes are relatively stable, which is exactly what analysts want to see in a core legacy brand. Consistency in those categories shows that the brand identity is intact.
Right. They aren't trying to completely change who they are.
Exactly. But the truly revolutionary data point in this section of the filing isn't what they're selling, it's how they are selling it.
Oh man, the shift in the sales channels is wild. Direct-to-consumer, or DTC, now counts for 52% of their total revenue.
That's a huge milestone.
It is. That's up from 51% last year, which means DTC is now officially beating out wholesale, which sits at 48%. And within that direct-to-consumer number, company-operated e-commerce makes up 24%.
It's a massive realignment.
To put this in perspective, it's like a successful indie band skipping the major record label entirely, bypassing the big distributors, and just selling tickets and vinyl directly to their fans on their own website. They control the whole experience, and they keep all the money.
That indie band metaphor works perfectly because the strategic advantage of this shift just cannot be overstated.
How much of a difference does it actually make on the margins?
A very significant one. When Levi's sells a pair of jeans through a traditional wholesale partner like Macy's or another major department store, they're selling at a wholesale price. The department store takes a significant cut of the final retail margin to cover their own overhead.
Because they have to pay for the mall space and the cashiers.
Right. But when Levi's sells that exact same pair of jeans directly to a consumer through Levi's.com or a Levi's-owned retail store, they capture the entire margin. It is significantly more profitable per unit.
Wow.
Furthermore, they gain direct access to the consumer's purchasing data, allowing them to predict trends and market far more efficiently.
But doing that has to be a logistical nightmare, right? Like, it's one thing to be the indie band mailing out 50 records from your garage. It's another thing when you are a global corporation shifting billions of dollars of merchandise.
Oh, absolutely. It is a profound structural transformation, and it's hidden behind a simple percentage shift from 48% to 52%.
It sounds simple on paper.
Right, but returning to your band analogy, bypassing the record label requires a completely different operational mindset. When you're a traditional wholesale company, your logistics are built around business-to-business shipping.
Moving big boxes.
Exactly. You put thousands of pairs of jeans onto massive shipping pallets, load them onto a truck, and send them to a handful of massive department store distribution centers. It is bulk, high-volume, low-touch logistics.
But when you shift to a direct-to-consumer model, especially e-commerce, you aren't shipping pallets anymore. You have to figure out how to pick, pack, and ship a single pair of 501s to a specific apartment building in Chicago.
Which requires an entirely different infrastructure. You need different warehouses designed for parcel packing rather than pallet loading. You need different inventory tracking software. You have to handle individual customer returns, which is notoriously expensive.
Yeah, returns are brutal for e-commerce.
Very much so.
Yeah.
So that shift to 52% DTC explains why a company like Levi's is constantly reevaluating its operational footprint.
Now, optimizing how you sell the product directly to the consumer is brilliant, but you still have to actually make the product and get it into the country.
That's the other half of the equation.
Which brings us to the legal bombshell buried in this 10Q. Controlling your sales channel doesn't mean much if your supply chain is hijacked by global politics.
This highlights the inherent vulnerability of relying on an international supply chain. A brand can optimize its sales channels perfectly, but it remains tethered to the geopolitical reality of international trade.
Here's where it gets really interesting. On February 28, 2026, the U.S. Supreme Court invalidated tariffs that had been imposed under something called the International Emergency Economic Powers Act, or IEEPA.
A major ruling.
And Levi's estimates in this filing that they paid approximately $80 million under these specific, now invalidated tariffs.
$80 million, just gone.
And we are talking about a supply chain that touches countries all over the world. The filing specifically mentions production in Bangladesh, Cambodia, Pakistan, and Vietnam countries directly impacted by these policies. So I have to ask, if the Supreme Court of the United States says the tariff is invalid, why hasn't Levi simply written down an $80 million refund on their balance sheet? When I realized I overpaid the IRS on my taxes last year, I immediately mentally spent that refund. I assumed the money was mine. Why can't a multi-billion-dollar corporation do the same thing?
Because the strict, uncompromising rules of corporate accounting collide violently with the messy reality of government bureaucracy.
I can only imagine.
Individual tax returns are straightforward. But for a publicly traded company, this filing is adhering to a specific standard known as ASC 450, which governs how companies report contingencies.
Contingencies?
Yes, essentially how they report uncertain future events.
Let me guess. Under ASC 450, you can't just assume the check is in the mail. You have to have the cash in hand.
Not necessarily cash in hand, but the realization of that gain must be practically certain. Under ASC 450, a company cannot recognize a gain, like a massive refund, if there's any substantial doubt that they will actually receive it.
Ah.
And in this case, the situation is shrouded in doubt.
Even though the Supreme Court ruled in their favor.
Even then, the filing notes that, yes, the U.S. Customs and Border Protection created a new functionality. It's called the Consolidated Administration and Processing Entries, or KPE.
Okay, KPE.
Right.
Yeah.
KPE was designed to facilitate a phased approach to processing these refunds. So the mechanism for the refund exists. However, following the Supreme Court ruling, the U.S. government immediately imposed new tariffs prospectively under an entirely different legal authority.
Wait, what? So the government lost the court case on the old rule and immediately wrote a new rule to keep charging tariffs moving forward.
Essentially, yes.
That sounds like a bureaucratic nightmare.
It creates total uncertainty. Because the refund program is complex and the government's stance on trade policy is highly volatile, Levi's cannot legally claim that $80 million is an asset on their books yet.
Man, that's frustrating.
They can only say they estimate they paid it, and they're monitoring the situation. It perfectly illustrates how a company can execute flawlessly on product design, completely overhaul its direct consumer sales channels, and still have $80 million of its own cash trapped in a geopolitical holding pattern.
It's staggering. So what does this all mean for how Levi's handles the money it can actually control? Because the unpredictability of that $80 million tariff situation really frames their internal financial housekeeping, which, honestly, reading this filing looks like a massive contradiction.
This is where we see the dual mandate of modern corporate leadership in action. Executives are forced to play two very different games simultaneously.
Okay, let's look at game number one, aggressive cost-cutting. In Q2 2026, they recorded a $13.5 million restructuring charge. This is following up on a massive initiative they ran in 2025 called Project Fuel. The filing shows this $13.5 million is going towards Sevnus, creating global talent hubs, and evaluating the mix of owned versus third-party distribution centers. Basically, they're firing people and streamlining their physical operations to save cash.
Which is entirely logical when you consider the global trade chaos we just discussed.
Sure.
If supply chain costs are volatile and you have $80 million locked up by the government, You have to protect your profit margins by reducing overhead elsewhere.
Right. But then we look at game number two. Simultaneously, while they're restructuring and paying severance, they are spending astronomical amounts of money to reward their shareholders.
Yes, they are.
On January 30, 2026, they launched a $200 million accelerated share repurchase. They literally handed over $200 million and immediately got 7.8 million shares of their own stock back.
That's a huge buyback.
And furthermore, they paid out $53.9 million in dividends just this quarter. And those dividends are rising from 13 cents a share in early 2025 to 14 cents now, and a newly declared upcoming dividend of 16 cents.
The payouts are definitely increasing.
So, isn't it incredibly contradictory to fire employees and restructure the business to pinch pennies while simultaneously dropping $200 million to buy back your own stock and raising the payouts to investors? Think about it like a pizza. If you're trying to save money on groceries, why are you paying a premium to buy back slices of your own pizza from your friends?
If we connect this to the bigger picture, your pizza analogy actually explains the mechanism perfectly, even if it feels contradictory on the surface.
Really? How so?
Imagine the company's total value is a pizza cut into 8 slices. If Levi's uses its cash to buy back 2 of those slices and then destroys them, the pizza is now cut into only 6 slices. The overall size of the pizza hasn't changed, but every remaining slice is suddenly much larger.
Oh, which means the stock is more valuable for the investors who hold on to it.
Exactly. It increases the earnings per share. As a publicly traded entity, Levi's has to continuously streamline operations to stay competitive against rivals. That's the restructuring piece.
Right.
But simultaneously, they must aggressively signal financial health and confidence to Wall Street. The $200 million accelerated share repurchase isn't a frivolous expense. It's a calculated financial mechanism to consolidate equity and reward long-term investors.
So it's not just throwing a lavish party while the plumbing is broken.
No, combined with a rising dividend, Levi's is sending a loud, clear message to the market. They're saying, despite the global chaos, despite the trapped tariff funds, despite the painful internal restructuring, our core business is generating so much free cash flow that we can afford to aggressively invest in our own equity.
Wow. It's a defensive maneuver dressed up as an offensive flex. That completely changes how you read a dry financial document.
It really does. You have to read between the lines.
So for you listening right now, whether you're prepping for a high-stakes business meeting, trying to manage your own stock portfolio, or you're just someone who occasionally needs to buy a solid pair of jeans, this deep dive reveals exactly how a legacy company actually survives into its second century.
It's a blueprint for survival.
Yeah. You don't survive by resting on your laurels or trying to be everything to everyone. You survive by brutally cutting distractions, like completely shedding a massive brand like Dockers.
Exactly.
You survive by fundamentally shifting how you operate, bypassing the middlemen to sell directly to the consumer and navigating the logistical headache that comes with it. And you survive by balancing the absolute chaos of global trade with strict, sometimes ruthless, internal financial controls that keep Wall Street happy.
This raises an important question, though. A thread that runs through this entire filing, which we should pull on before we finish.
Ooh, I love a lingering question. What stands out to you?
If we build on that earlier data point, the fact that direct-to-consumer has now officially overtaken wholesale for Levi's, we're looking at an 1853 dry goods company, one of the oldest and most established brands in America, successfully shifting its entire model away from third-party retailers.
Yeah, that's huge.
If they can do it, what does this mean for the future of the traditional department store? Right. If the anchor brands like Levi's realize they don't actually need the massive retail stores anymore, will the physical retail ecosystems that defined the 20th century eventually become completely obsolete?
That's a huge point.
Are we heading toward a future where there are only flagship brand stores and direct-to-doorstep shipping with nothing in between?
That is a fascinating and, frankly, slightly terrifying thought for anyone in commercial real estate. If the cargo ship decides it doesn't need the port anymore, what happens to the port? It makes you look at the entire retail landscape differently.
It definitely changes the perspective.
So the next time you put on a pair of jeans, take a second to think about the invisible global machinery that got them into your closet. Think about the strategic retreats, the Supreme Court battles over millions of dollars, and the relentless financial engineering hidden in the threads. It turns out that dry, boring SEC filing we started with is actually the blueprint for surviving the future.